Welcome to this explainer, where we're going to absolutely demystify the complex, invisible forces of the financial system. Look, if you've ever felt like the economy is this giant machine running on some secret language, well, you're definitely not alone. Today, we're taking those intimidating concepts and translating them into highly relatable, everyday analogies. By the time we wrap this up, you'll understand exactly how the money you earn at your job interacts with the absolute largest institutions on the planet. Let's get right into it. Okay, so why isn't a dollar always worth a dollar? Let's dive in by asking this foundational question about the money sitting in your pocket right now. Because currency value, it isn't just about the number printed on a piece of paper or glowing on a screen. Honestly, the symbol on the bill actually means absolutely nothing on its own. What truly matters is the economy standing right behind it. The value of your money represents the strength of the country that issues it, its global trade balance, and, well, how much people actually trust the entire system. So, level one, the illusion of money. We're starting right in our comfort zone here to totally shatter the illusion that money is static. Most of us, we think that if we put a $20 bill in a drawer, it's going to be exactly the same $20 a year from now. But standing still in finance actually means you're falling behind. You hear the word constantly, but inflation isn't just prices going up. It's the slow, systematic erosion of your money's purchasing power. Imagine buying a brand new bag of chips, opening it up, and finding it's already half eaten, right? That's inflation. It's not some temporary price spike caused by a supply chain hiccup. It's a situation where more money is chasing the exact same amount of goods, quietly stealing your future value. Let's put this into perspective. Imagine your town has exactly 100 people and 100 loaves of bread. Everyone has $10 and a loaf costs $10. Perfect balance, right? But what if the government prints more money, say handing out an extra $1,000 to everyone, without creating a single new loaf of bread? The baker instantly realizes everyone has more cash, so the price of those exact same 100 loaves simply skyrockets. Printing money doesn't magically create wealth. Without actual economic growth, it literally just creates inflation. Moving on to level two, the middlemen. When we hand over our paychecks, we see the numbers pop up on our banking apps and just kind of assume our cash is taking a nap. Most people picture a bank as this big, secure safe guarded by a dragon, just sitting on a massive pile of gold. But in reality, banks are simply middlemen. Think of them as financial matchmakers. They're pulling idle money from savers, people with a surplus of cash, and handing it right over to deficit units, which are just people and businesses that need capital to buy homes or expand companies. Honestly, your money is out the door almost as soon as you deposit it. Let's see how this actually builds in practice. Step one, you deposit $1,000. Step two, the bank keeps just a tiny fraction of that in reserve, just in case you come asking for some cash back. Step three, they take the remaining $900 and immediately lend it to someone who wants to go buy a jet ski. This process, which is called fractional reserve banking, is quite literally the beating heart of our economy. Banks are effectively creating new money and expanding the total money supply by lending out cash they don't actually hold in full. Wild, right? So the really crucial point here is understanding how this system charges for the use of that money. Basically, interest is money's way of charging rent. Simple interest, that's just a flat fee. But compound interest, well, that's when your money creates clones, and then those clones also start demanding rent. On a credit card, compound interest can turn a missed payment on a $12 burrito into a $50 regret real quick. But if you're the one doing the investing, it duplicates your cash like an absolute cheat code. All right, level three, the macro machine. Zooming out to the broader global ecosystem, we find the massive players who are really pulling the strings. Every massive institution plays a highly specific role in moving, multiplying, and sometimes destroying wealth. You have commercial banks acting as the everyday workhorses. You've got private equity firms acting as corporate house flippers. They buy companies with leveraged debt, strip them down, and sell them for parts. And then you have venture capitalists acting as the gamblers, spraying millions of dollars at startups, fully knowing most will fail, but hoping just one hits a 2,000 times jackpot. But sitting way up above all of them, the puppet masters. Central banks, like the Federal Reserve in the US, essentially play God with the economy. They use monetary policy to control the money supply and set the foundational interest rates. When the economy is looking sluggish, these puppet masters lower interest rates to flood the system with cheap money, which encourages businesses to borrow and hire. But when inflation spikes and prices start getting totally out of hand, they radically jack up rates to slam on the brakes, making borrowing incredibly expensive. Let's move to level four, stripping the jargon. Let's decode some of that financial jargon that news anchors so confidently misuse on television every single night. Take these two words, which are constantly used as synonyms but absolutely are not. A deficit is a flow. It's just the gap between what the government collects and what it spends in a single year. Debt, on the other hand, is a stock. It's the accumulating mountain of all those past deficits combined. So when a politician goes on TV and proudly claims they cut the deficit, all they really mean is they're digging the debt hole slightly slower than they were last year. Make no mistake, that overall debt mountain, it is still growing. Next up, we have liquidity. Now, a liquid asset is cash. It's perfectly and instantly spendable. An illiquid asset is something like a house, a piece of fine art, or startup equity. You might be a millionaire on paper, but you absolutely cannot quickly convert a house into cash on a Tuesday to pay an emergency bill by Friday. Liquidity is simply how fast you can turn an asset into cash without taking a massive loss on its value. And confusing paper wealth with actual spendable liquidity, that is exactly how major financial disasters happen. And this is the exact fault line hiding underneath major banking failures. Consider Silicon Valley Bank. They didn't run out of money entirely. On paper, their assets actually exceeded their liabilities. But when everyone panicked and asked for their cash at the exact same time, the bank's money was tied up in assets that just couldn't be moved fast enough. It wasn't that they were broke, it was a pure liquidity crisis. And finally, level 5, the cheat code. Let's bring all of this macroeconomics back to your personal empowerment. We've talked about inflation eroding your money and central banks moving the markets. So how do you actually fight back and rig the game in your favor? It all comes down to knowing the difference between trading and investing. Trading is a sprint. It's this high-stress job of trying to guess short-term price movements, constantly jumping in and out of the market. Investing, however, is a marathon. It's not a casino, and it's definitely not a lucky lottery ticket. True investing means buying quality assets, like actual slices of real businesses, and letting that compound growth do the heavy lifting while you literally sleep. As our source material beautifully puts it, wealth isn't built in days, it's built in decades. Look, time is your absolute most valuable asset and frankly your best employee. You do not need to be some Wall Street insider to win at this. A little money invested consistently, placed it in the market, and just given enough time multiplies. It happens slowly at first and then incredibly fast. I'll leave you with this provocative thought to wrap up our explainer today. Interest is either your worst enemy, slowly burning your finances to the ground, or it's your absolute best unpaid employee. The financial system is a massive machine constantly moving money around. And now that you know the rules, you get to decide which side of the equation you stand on. Are you paying the rent, or are your clones out there collecting it? Think about that one.
At the end of the day, it's not about how much you earn, it's about how well you manage it. If this video helped you understand money a little better, then you're already ahead of most people. Make sure to like, subscribe, and stay connected with Investing SQ, where we simplify finance for your everyday decisions. And before you go, write down in comment section the place from which you are watching this video, and don't miss our next video. It might just save you thousands. See you next time.